It's been called the mother of all ratios by its fans. It's also been accused of being partly responsible, at least, for the downfall of banks such as RBS, who went on a debt-fueled spending boom. It is return on equity. And in this video, we're going to take a look at what it is, why opinion is divided, and whether or not it's a ratio that you can trust. It's certainly a pretty important ratio. You'll see it quoted all over the place. CEOs of banks and companies sometimes have their pay linked to it, and it's certainly one of the ones that an investor wants in their armory. So let's look at its good points and its bad points. Okay, well, first of all, what is it? Take two companies, all right? You're trying to compare them as an investor. They both generate the same profit, £50 million sterling, all right? Which one do you buy? Well, the answer is you couldn't possibly make the decision on that amount of information. And the key thing I'm getting to here is, what if one of them is tiny and the other one is huge, all right? One of them, in other words, is generating the £50 million much more efficiently than the other. Enter return on equity. It is a ratio that attempts, say the fans, to bring together the profit and loss account and the balance sheet in one fell swoop. It essentially says, how much bang do you get for the buck that you've invested as a shareholder? All right, so it's a two-part ratio, and there are various ways of calculating it. All right, and apologies to any Americans out there, I'm going to use slightly British language in just a moment. So what is return on equity? Well, the name is simple enough. Okay, and what this ratio does is essentially it takes a profit figure. It actually takes the profit after tax from a company's profit and loss account and compares it to the equity capital employed in the business. That's the contribution made by a firm's shareholders, okay? And that is known as equity capital employed or shareholders' funds, all right? So basically all you do is take profit after tax, what the Americans would call net income, all right, and divide it by the equity capital employed or shareholders' funds or net assets. Now, for anyone who thinks I'm going a bit quickly at this point, I'll refer you to a couple of videos at the end, which will give you the background. Okay, so profit after tax over equity capital employed, and just for good measure, it's normally expressed as a percentage. So we can multiply by 100% to get the answer. All right, so how would that work in principle? What would that give us if we put some numbers in? Well, supposing I'd gone to a set of accounts and pulled out a company with profit after tax, all right, that's quite near the bottom of the profit and loss account, all right, of 10 million. So profit after tax, 10 million. These numbers are in sterling, all right? And the total shareholders' funds, which, because balance sheet's balance is the net assets figure as well, the equity capital employed, the bit that shareholders have put in to fund the business, is 100 million. Again, in sterling, all right? 10 over 100 times 100%, not tremendously difficult maths, would give you an answer of 10%. All right, now there are plenty of websites that will just crunch that out for you and sort of hand it on a plate, but what does that mean, 10%? Well, essentially it says this is the profitability relative to the firm's size, 10%, all right? Now, as an isolated number, it means absolutely nothing at all. You need to compare it to some things. Right, now what would you compare it to? Well, last year, that's a good start. If last year was 5%, this year's 10%, return on equity's doubled. But that's not really enough, all right? I want to know what else I could be invested in. I mean, if a bank account offers me 20%, unlikely at the moment you might say, then why would I take the risk of investing in a company which could go bust after all to earn 10% as a shareholder? Why not just sell my shares and put the money in a bank account, all right? So you want to know what other investments are offering. You might want to know what other much more similar investments are offering. So you might compare this company to its peer group, other companies that are like it, to the wider industry, okay? You might compare it to target. What did the directors promise, all right? And return on equity is one of those numbers that directors do sometimes promise to deliver on the following year. There's a good reason for that. We'll come back to it in a moment, okay? And of course, easy for me to say, of course. Much more difficult to get this piece of information, but okay, this company is generating a 10% return on the equity capital it employs, all right, from shareholders. But what is it costing to generate that return? All right, what I'm going to suggest is, and this is harder information to get hold of, but it's just food for thought in this video, or maybe take this further in another video, that if a company generates a return on capital employed of 10%, you might think, brilliant, that's a pretty good return on my money, if you like. But if it's a very inefficient company, it might be having to borrow much more expensively than 10% to deliver that sort of return, right? So in other words, we sort of need to know what it's costing to generate the return, all right? But that will be the subject of another video. Okay, most investors would look at last year, would look at similar companies and sort of other investments where their money could be parked. Okay, so by itself, not too meaningful. Combine with other ratios, it gives you a much fuller picture. All right. Now, so far sounds fine. So this captures in one number the total return for the amount of capital employed. That's why fans say it's almost the only ratio you'll ever need. Okay, but it's by no means perfect. Okay, there's a big word missing, and that word is risk. Okay, now here's where critics say, actually, there's a bit of a problem with this number, all right, because it doesn't explicitly consider the risks that have been taken to generate that 10%. And one risk in particular stands out, and it's the one that banks took on, okay, right before the credit crunch. Companies joined them, and that's debt, gearing, okay? How much borrowing has been needed to generate this kind of return, all right? Now, let me just illustrate the problem using some fairly straightforward numbers, all right? Return on equity is a good ratio. It's one of the ones that's useful to have in your armory, but it's not perfect, all right? Let me give you a quick scenario, okay? First of all, imagine that a business is funded with equity of £30,000 sterling, and this might look a bit extreme, but debt of £970,000 with a 4% interest rate. So there's £1 million in total invested in the business. All right, the capital employed is £30,000 of equity that you've put in, shareholders have put in, and debt, that's borrowings, 970,000, to give total capital employed of £1 million, equity plus debt, paying 4% interest rate. Okay. Now here's the point. That debt comes at a price. All right. That debt of 4% is going to cost you about 38,800 per year, per annum. Okay. In interest charges, that's 4% of the 970,000. Okay. So what? Well, here's the point. Supposing the directors manage to increase the assets of this company, all right, by 1%, the following year, all right? 1% of £1 million is 10,000. Unfortunately, that's going to be wiped out by the interest charge, 38,800, all right, completely wiped out. All right, so any return, if the return's only 1% on the assets employed, that's not enough. Okay, so the company will make a loss for the year. But what if the directors, all right, and the loss, by the way, will wipe out pretty much most of that equity, all right, because you've got interest of 38,800, a return of only 10,000, right? That's enough to almost wipe that out completely. But what if the directors can make a return of 7%? Okay, that is 70,000 on assets employed of £1 million. Take out the 38,800, okay, and you're left with 31,200. So if we manage to boost our assets by 7%, still got to pay the interest bill, okay, we're left overall with a profit, little symbol there, of 31,200. And my point is this: what we've managed to do after paying off the interest on debt is almost double the equity in the business. Okay, because the IOU, the original borrowing, won't change. That's a loan of 970,000. All right, what we've done is effectively is almost double the equity in the business off just an overall return of 7%. So what I'm saying here is that that massive gearing, that massive debt loaded in there, can substantially boost the overall return on equity, okay, much higher than it would otherwise be. I mean, put it another way, if that 1 million was all equity and no debt, then a 1% return is a 1% return, 10,000. A 7% return is a 7% return, 70,000. But the effect of debt is to magnify the return on equity, okay? Effectively, a return of 7% almost doubles the number in there. And that's precisely what those banks were up to, okay? As an investment bank in the good times, okay, what you can do to seriously impress your shareholders is say, we will hit return on equity, we'll boost return on equity, and shareholders think, brilliant, thank you very much, okay? And what you do is you borrow massive amounts of money, you shrink your equity base down as far as you possibly can, okay, so you get your equity base nice and small, you borrow up to the eyeballs. There's a bonus here, because interest on debt is tax deductible for companies. Net effect, without doing a tax video here, is you get another little boost, okay? And the whole thing adds up to potentially a sort of rocket ship in terms of return on equity, but with very little real extra value being added underneath by the directors. In other words, it's a financial engineering trick, and that's the bit the critics don't like. They're saying that companies that borrow heavily can boost return on equity and almost pull the wool over the eyes of shareholders, okay? So, to recap, we have a kind of catch-all ratio called return on equity. It attempts to give you the total return as a shareholder for the amount of capital employed on your behalf. Sounds good. The number by itself is a percentage, and by itself it's largely meaningless. You need to compare it to things to get a true picture, okay? And while I'm on the subject, there is some debate even about the calculation, all right? So you take the profit figure, all right, the latest 12 months profit figure, and put it over the equity capital employed. Which equity capital employed? End of the year? Start of the year? Or do you average the two? All right, so for pedants, if you like, there's even some debate about how the calculation's done, but leaving that to one side, even when you agree how the calculation's done, you've got to compare it to things. In isolation, it doesn't mean anything, okay? Once you get over that, it can be a useful ratio. You've then got to decide whether it tells you enough about risk. And my argument is that by itself, it doesn't really tell you enough about risk. In other words, what I'm saying is you can boost return on equity as a clever company director largely through debt, provided you're in a bull market where asset prices are rising. Right, and that's precisely what some of those bank directors that are in the headlines right now did before the market collapsed around their ears. And I nearly forgot to mention, earlier in the video I said for those people who found that a bit quick, I'd give you some other video references. So I did mention profit after tax and profit and loss accounts, so please see my video, What is Profit? All right, and for anyone who wants to know a bit more about capital employed and equity shareholders funds and net assets, all those terms I threw in quite quickly, please have a look at my video, What is a Balance Sheet? With those two behind you, hopefully this video will then make a little bit more sense at the start for beginners. All right, and once you've seen those three videos, then do take a look at my other video, which is 6 ratios every investor should know. And that'll take you through some other key ratios, giving you the pros and cons and the ins and outs as you travel.